And most Americans, I mean, I'm old enough to remember it, but most Americans don't remember the last time we had significant inflation, right? And so, I mean, we went through a period there where inflation was just consistently low, and in fact, if anything, the Federal Reserve was worried about deflation for much of the last decade. So the fact that we have seen overall wages go up 35% since the pandemic, food costs go up 37%, menu costs go up 32%, right? All those numbers are pretty shocking, right? And I think that in many ways, you're seeing consumers that are feeling stretched because they just, quite frankly, aren't used to seeing prices going up at such a rapid clip.
No, they're not. They're absolutely not, and, I hear it all the time. I've said it many times that the US consumer did not like the price increases that they saw at chains that they believe are supposed to be low price.
Yeah,
So
yeah.
your McDonald's, your Subways of the world, whatever, that is where this kind of pushback, I think, is coming from. Why are some fast food restaurants having such a tough time this year? Hello, this is Jonathan Mays, editor in chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with Chad Moutray, the chief economist for the National Restaurant Association. We wanted to talk with Chad for two big reasons. First, the association published its data abstract for the restaurant industry, which shows some surprisingly low profitability for both full service and limited service restaurants. But maybe you shouldn't be surprised. We talk about why restaurants are less profitable today than they were before the pandemic. But we also talk extensively about the economy and why it is so unfriendly to fast food restaurants in particular. Fast food restaurants in an economy like this would normally be getting more customers, but right now they are getting less, which has spawned one of the most extensive value wars that we have seen in years. Chad talks about and helps us through why the economy has been so difficult for that sector. We're talking the economy and profitability on A Deeper Dive, so please check it out. Okay, I'm here with Chad Moutray. Chad, welcome to the podcast.
It's always happy to be on your show, Jonathan.
Let's just talk about the state of the environment, restaurant environment right now. Going into 2025, some of us, me included, thought things were going to be better than what has happened. So what's your take on things? What's going on?
Well, I think, like you, I think that we certainly came into this year with a lot of optimism that things were going to be, pretty strong, right? Maybe not as strong as last year, but still pretty decent. 2.4% growth in GDP, overall prices continuing to moderate, sales, maybe softening a little bit, but still not horrible relative to last year. And then, we got tariffs. We got a lot of other things happening. I call this the year of shock and awe, certainly in the spring months. And you certainly saw confidence dampen pretty significantly in that time frame, as well as, I think the consumer has pulled back a little bit. Certainly you saw that a lot in the spring. Things started rebounding a bit, but I think we're back to this point now where the consumer in general is very cautious. They're still prioritizing restaurants, but perhaps going to restaurants less than they were before, I think, as they've become a little bit more cautious. So this year is not quite what we thought it was going to be, but it's not horrible either. You're still seeing a little bit of resilience, which is encouraging.
Right. I mean, on balance, in difficult times, consumers continue to dine out at restaurants.
Yeah.
I mean, even that's one of the good things about the industry is, frankly, in some respects, it's recession resistant. Now, I know a lot of operators wouldn't think that way all the time, especially these days, but it tends to be a little bit more recession resistant than people really appreciate. The issue that we see this year is that it's kind of upside down.
Yeah.
And that the restaurant chains that we're hearing that have the biggest challenges, at least in getting customers back, are like fast food restaurants. And then, we see a little bit higher end restaurants are doing just fine. In fact, if I try to get a reservation at any decent place, good luck. So, you still see a little bit about that. Do you see anything in the economy that really might suggest something?
Well, there's two trends there that I think are worth noting. The first is this trend, which I call the two Americas, right? That we still are seeing, there are a lot of Americans who are doing quite well, right? Overall, the stock market's at a record high, housing values are at a record high, wage growth has been pretty solid. And as a result, you're still seeing. I mean, I go to restaurants where it's still busy, right? You're still seeing people who have money are spending it, and you see that in vacations, you see that in restaurants, and in other categories as well. And so there's part of that notion. I think that has really kept the economy afloat over the last couple of years. Is that you're seeing those with money are still spending. The challenge for restaurants is that lower and middle income Americans are largely feeling the pain of just having a lot of inflation over the last couple of years. And that's really where that value conversation comes in very, very strongly. It's certainly where you're seeing some of the weakness, particularly in the fast food segment and others. I think the restaurants that have done really well, and I think Jonathan, you've done a good job of describing this in your columns and podcasts, are those ones that are communicating value, right? The ones that are where there's been a blurring of the lines between fast food and maybe family dining, right? They've really been able to capture that value conversation and getting people in the store, right, to show that they are really giving you the best bang for the buck. Now we know that not all of value is price, but certainly for many Americans it is.
Yeah, I mean, the thing that I heard, that I've heard lately, it seems, in fact, if you think about it, the quick service restaurant industry has now been going for a year with this, with essentially a value war or discount war, however you want to term it. And we don't really see it showing up in at least the restaurant level traffic data. So it doesn't appear that it's all that effective in actually convincing that lower income consumer to go back. And what you're saying is that the people with a little bit more money aren't really responding to value as much or to value marketing. And they're not, like in past economic challenges, shifting spending to some of these lower priced fast food options. They're just maintaining where they've gone all the time. And the result we have is we still have a fast food sector that just seems to be losing traffic.
Yeah, and I think, we've been predicting a recession. Well, I haven't been, but a lot of economists have been predicting a recession for the last couple of years, right? And it really hasn't materialized. And a large part of that is that, number one, we don't give the consumer enough credit, right? That really is what's helped prop up the overall economy. But the second part of it is that you do have those household incomes with over 150,000 owned a home before the pandemic. There's a lot of those kind of demographics out there where spending, they might be a little bit more penny pinched than they were before, but they're keeping the economy afloat.
Yeah. I think maybe, I wonder if it's, and you could help me out with this theory. It might be probably helpful to think that the fact of the matter is we just got through the worst inflationary environment that we've seen in 40 years?
Yeah.
And if we remember what the restaurant industry was like going back 40 years ago, I mean, frankly, it's not really comparable. We spend a lot more money at restaurants today than we did 40 years ago. The restaurant industry serving that consumer is far more sophisticated than it was 40 years ago. And so
Yeah.
it's not really, so we're really going through, for the current modern restaurant industry, a pretty unprecedented time. And that's probably why everything is upside down.
And most Americans, I mean, I'm old enough to remember it, but most Americans don't remember the last time we had significant inflation, right? And so, I mean, we went through a period there where inflation was just consistently low. And in fact, if anything, the Federal Reserve was worried about deflation for much of the last decade. So the fact that we have seen overall wages go up 35% since the pandemic, food costs go up 37%, menu costs go up 32%, right? All those numbers are pretty shocking, right? And I think that in many ways, you're seeing consumers that are feeling stretched because they just, quite frankly, aren't used to seeing prices going up at such a rapid clip.
Right. No, they're not. They're absolutely not. And I hear it all the time.
Yeah, yeah,
And I've said it many times that the U.S. consumer did not like the price increases that they saw at chains that they believe are supposed to be low prices.
yeah,
So
yeah,
your McDonald's, your Subways of the world, whatever. That is where this kind of pushback, I think, is coming from, and aimed at those companies that they believe should be cheaper than they are. But the fact of the matter is,
Mhm.
Restaurant costs have soared since 2019.
Yeah, and I think we economists don't always help things because we talk about moderating inflation, but the reality is that the aggregate, right, the prices aren't going down, right? They are still up quite a lot relative to where they were 5, 6 years ago.
Yeah. Um, Interesting. So that really is a good lead into one of the big things that I really wanted to talk about, which was this data abstract that you guys just published over at the association. And this specifically is looking at the income before income taxes at full service restaurants is 2.8% of
Yeah.
sales. And for limited service restaurants, it is much better at 4% of sales. Both of those numbers absolutely blew me away. What do you make of that?
Well, number one, we've been talking for quite some time about just how narrow the margins are for restaurants, right? I mean, I think the standard talking point, Jonathan, you probably were using it too, is 3 to 5 percentage points, right? So was the typical restaurant profit margin. Now, I guess we could say 2 to 4, right? Or 3 to 4. It's clear, number one, that those costs have continued to rise. We saw certainly labor taking a bigger share than it did before the pandemic. Food costs, as I just said a second ago, are up 37%. Wages are up 35%. And now you've seen those numbers narrow, right? So that 2.8 number before the pandemic would have been 4, right? And that 4 would have been 6, right? So we've seen as these costs have continued to multiply that those profit margins have gotten squeezed. Now this is the average, right? The reality is that there's a wide variance there, right? One of the things that I talk about quite a bit is people say, well, that restaurant is super busy, right? Yet they went under, right? And the reality is that the math still has to work, right? Even as these costs have continued to rise, yes, you can pass on some of those costs to the consumer, but the consumer, as we've just mentioned in the previous kind of questioning, is also feeling pinched, right? And so, the worry amongst a lot of restaurants is, you don't want to raise menu prices too much because you're going to turn off the consumer, you're going to affect overall traffic. So the overall bottom line has got squeezed in that conversation. So such that, again, your average for a limited service restaurant is 2.8%, which is pretty paltry relative to what I think some other sectors you might see.
No, it always almost makes me wonder why we haven't seen even a higher rate of failures given those numbers. I mean, if we're looking at 2.8%, I mean, let alone 4 or, well, I mean, let's just ignore the 4 for a minute, but the 2.8%, I mean, that's a really kind of a remarkably low number. And if you break that down in full service, you see
Yes.
a lot of restaurants based on, the lowest quartile of those full service restaurants are basically losing money on
Yeah.
average, which is remarkable to me. It just illustrates just how difficult this industry can be for a wide swath of operators.
And the other interesting part of that is that, we're dealing with lag data, unfortunately, but the most recent data I've seen on openings and closures shows that there are more openings than closures, right? Which says the reverse of that, Jonathan, which is that despite these really low profit margins, you still are having people who want to get into this business, right? That gives me a little hope, right? That we're still seeing more openings and closings, and that might shift, right? And we certainly have seen some high profile closures in the last year or so. Those are a little elevated relative to historical norms, but I do take some positive, optimism there that openings continue to exceed, and that's not just nationally. You see it in a lot of other states as well, and it says, number one, people still want to get in this business despite how tough it is, despite how tough the math is. It's still a great business to go into for many Americans.
Yeah. Yeah. I mean, it's both to me in the restaurant industry, sort of a blessing and a curse.
Yeah.
Like one of the stories that I've probably mentioned this on the podcast before. If I haven't, I'm going to mention it now. We have in the Minneapolis market a pizza concept, Young Joni, independent pizza restaurant. And, the chef won a Beard Award. It was, by every measure, a highly successful restaurant. Like you would go in, you couldn't. That's one of the aforementioned restaurants that you can't get into because it is so popular. So good luck getting a reservation on a weekend, for instance. And, over the past decade, it actually played a massive role in sort of lifting up its neighborhood in Northeast Minneapolis. Well, it's about to close because the landlord is essentially is executing a provision that enables them to dramatically increase the lease cost. And so it's closing. From what I understand, that landlord has several options, several interested parties looking at opening a restaurant on that same site, which to me is just sort of like anytime one restaurant closes, there are multiple restaurants looking to move in. So it both offers, in constantly intensifying competition, but also giving permission for landlords to dramatically increase lease rates because that landlord knows that they're going to be able to fill that spot. So,
Yeah.
both makes the industry more competitive, also makes it much more difficult to survive in a couple of bad months.
Yeah, that occupancy cost is a huge driver, right? I've seen other restaurants even here in Alexandria, Virginia, where I live, where the rent was really the deciding factor of why they had to close. You've seen kind of historically those restaurants that own the land, own the property, or have given a little bit of a leg up. But if you're paying a lot of rent, it means you gotta make sure that you have the revenue to justify that. And the example you give, hopefully the next restaurant is able to make that math work, but in many cases, even busy restaurants can't.
Yeah, I have said before that writing a bad lease has killed more restaurants than almost anything else. When you still hear it, you hear it certainly on the chain side where you got these aggressively growing restaurant chains are signing expensive leases to get sites and et cetera. And then of course you got, you got independent restaurants who God love them, are really confident in their business. They're taking a risk and don't always see that, the leases that they sign might be a little excessive, and that's the result. Now it seems like I'm looking at full service restaurants, occupancy costs average 5.7%. Can you give
Yeah.
me context on that? Is that historically high, or where is that at?
I think that's roughly where what has been for a while. I think one of the nice things about the overall survey on these particular data is it allows your full service restaurant, your limited service restaurant of various sizes to be able to look down the list and kind of not benchmark, but really see where the overall median is for a variety of these costs, whether it's labor, whether it's food, utility costs, et cetera. And so it gives you a little bit of a comparison to be able to say, here's what that kind of median is in terms of the, that overall P&L. Where do I fit? And I guess if you see that ratio is too high relative to that median, what can I do to become a little bit more efficient, right? And so I think it does hopefully provoke some conversation in terms of driving some efficiencies, or at least trying to get a little closer to that median to see, again, to compare yourself to where other restaurants are more or less in that same space.
Well, the number, to be honest, the number that actually surprised me the most that I'm looking at is on salaries and wages on the full service side. On the full service side, limited service salaries and wages median is 31.7%. That's roughly, it might be, for certain companies, that might be a bit high, but
Yeah.
that's median, but for full service restaurants,
Yeah.
the median salary and wages cost is 36.5%.
Yeah.
That
You have,
is
you have 2/3 of all of your expenses are coming from wages and salaries or
right.
food and beverage costs.
Yeah.
Pretty astounding.
That 36.5% though seems high to me. That just seems like that's gone. Is that the result of late, or is that historically high, or where is that at?
But that's slightly higher than it was before the pandemic, right? I think you've seen a lot of wage growth over that time period, and I think certainly technology and efficiencies are playing a role, certainly maybe a bigger role in the limited service. But so that I think it's just headcount and higher wages for the most part. And so that's higher than it was before the pandemic.
Yeah. Yeah. I mean, you hear from one of the things that every so often I hear from a fast food operator is if I start talking about, say, Chili's value meals, for instance,
Yeah.
is that you'll hear from limited service restaurant operators and say, well, Chili's can do that because it doesn't pay, it doesn't pay minimum wage to its servers.
Yeah.
Like, I mean, if you've seen the P&L for some of these full service restaurants, they're not really that great. And that benchmark really sort of pretty indicative of that because, the salaries and wages at a full service restaurant is 36.5 versus 31.7 for a limited service. That's kind of a big deal.
Yeah, I mean, number one, very few people pay minimum wage, given that it's still nationally still just $7.25, and the market just is nowhere near that. The other part of it is, why do you go to restaurants? You go to restaurants for hospitality. You want to be waited on, right? Yes, you can create efficiencies with some technology, certainly behind, in many ways, both customer facing as well as in the kitchen. But in full service restaurants, you want that hospitality, you want that service. And so you really can't cut back on that in many ways, full service segment, because that's why people go to your restaurant.
So how long have you guys been doing this data abstract, and what's the goal? I know you've sort of alluded to it earlier, but what's the whole overarching goal here of publishing an abstract?
Yeah, we've been doing it. I think this is the fifth or sixth time we've done it. We started doing it 2010. So we did it in 2010, 2013, 2016. And then we did it again last year. And the goal is to do it every other year moving forward. Well, we don't plan on doing this annually. It is quite an exercise. It's very cumbersome for the 900 restaurants that are having to fill it out. But we did it just because we felt the last year's data was still coming right off of the pandemic. We needed another year to get beyond it. So we'll be doing it again in 2 years, and just every 2 years after that. And again, I think the large part of why you want to do it is to give just kind of some measure to say, here's where I am as a restaurant. What is that relative to some meaning of a similar type of restaurant in my segment, whether that's by size, whether that's by a number of other different categories that are out there.
Anything about the data this year that surprised you?
I think the surprise here, number one, was that we did see, or maybe it shouldn't have been a surprise, but I think the biggest surprise was just how that 2.8 and 4% number, right? I think that really was the headline to me of this particular report, was that you have seen that squeezing of the overall profit margin as a result of, again, just really super high cost increases over the last couple of years. So again, it shouldn't have surprised me, but it did. And I guess the other kind of surprise is labor costs was a little higher than what we saw before the pandemic, and food costs actually were a little lower, not by a lot, but a little bit lower. And that just simply accounts for, just when you look at the share of the pie. Obviously, I just said to you, food costs are up 37%. So there were some efficiencies there that I guess made it slightly lower than what we were seeing before the pandemic.
Yeah, right. What are the other costs? So what we have here, one of the things, if you look at the abstract, we've got, going back to full service again. So you got 66.5% with food and labor, 5.7 occupancy costs. What are the other costs that you were measuring on this?
Well, I mean, we break out for the operating expenses by number of categories, not just the wages and salaries, but your music and entertainment, marketing, utility, occupancy. We just talked about that a second ago. Repair and maintenance, depreciation, general and administrative, corporate overhead. So I think that really allows folks to go a lot deeper into some of those overall expenses. Some are broad categories, so there's not everything that's in there, but at least give you some broad categories. And on the cost of goods sold, we're looking at both food and beverage, non-alcoholic beverage, but also alcohol. So I think it's a little bit of a breakout for that as well.
So getting back to the profitability question, I mean, is it fair to say that this basically tells us that the restaurant industry is in as precarious a position, not including, say, the pandemic, as it's been? Because I mean, like 2.8% income when you got the bottom quartile is at negative. and then just 4% for limited service restaurants. And then you got a period of time in which the consumer is very deliberately cutting back on dining out. And then you have these wild cards like third-party delivery creating some havoc with the business model. I mean, is it fair to say that the industry is as in a precarious a position as it's been?
I mean, everything I said about resilience earlier, right? And yet, when we asked restaurant operators about the next 6 months, they're very anxious, right? And a large part of why they're anxious is they're seeing these cost pressures. They're seeing a very anxious consumer themselves, right? And so there's a lot of uncertainty there. And so yes, I would say that there is a precariousness to it, right? It's a very challenging environment to be a restaurant operator today, and yet many do, right? And many make a great living at it. But there are a lot of challenges out there that really, again, the math has to work.
So what's it going to take? One last question. What is it going to take to get, the restaurant industry back into a healthier sales and traffic growth mode, unlike where we're in right now? What's it going to take? Because it seems like that's a tough question, because we should be in a better spot than we're in now.
I think that once we have greater clarity in the overall economy, we're going to see some improvements there. I do think that there is money sitting on the sidelines in many ways for both the consumer and the business side. I mean, the number that I'm going to be watching very closely, quite frankly, as an economist, is what's happening to the labor market. I think the whole narrative of the economy and resilience in the economy really shifted a lot in the last month as we've seen some pretty significant downward revisions to job growth. People who have jobs, who are making great wages, are going to restaurants and spending, right? And so that to me is one of the best indicators to look at as far as the health of the restaurant sector. So if we see slowing growth in terms of job growth moving forward, that certainly is something that will weaken overall activity moving forward. If on the other hand, you see labor market continue to rebound a little bit, you see consumer spending continue to rebound a little bit, I think that you'll see some signs of strength there. I think that there are a lot of mixed messages, even in terms of upward and downside risks to the economy. So stay tuned. I don't think we're going to have a recession later this year, but again, I think the number to watch is going to be the overall labor market.
Yeah. Yeah. I will say this one last thing about economists. Eventually, if you just keep predicting a recession, eventually you'll be correct.
And to be fair, I actually 2 years ago did not predict a recession, so I was one of the few that didn't. So eventually I might be wrong though, right, Jonathan? So
Yeah,
we'll
yeah,
see.
eventually you are. Well, I mean, as I said, we've been waiting for a recession for 2 years. I mean, it was, 2 years ago, and it was in Bloomberg that it basically said there was a 100% chance of a recession in the next year, and it never happened.
Consumers are a feisty bunch. Lots of resilience out there, right, in terms of spending. I think that too, America's story that I told early on was a large part of that.
Yeah, right. Chad, this was great. Really appreciate you joining me on the podcast.
Thank you. Anytime.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons. Artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. But please subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.